why I kind of prefer. Sometimes I prefer the financial market, that's the currency market, to the synthetic and crypto because when it comes to currency pairs, there's actually a time factor, right? So you actually know what time you should be trading, what time you should be staying out, and all of that. That's why I kind of love currency because of that flexibility. For instance, I'm not trying to trade the Asian sessions. Like you don't find me trading during Asian session, midnight, all those other hours of the day, right? When it comes to currency pairs, there are specifics which you look at and it gives you a a framework, right? Like if you're told that you, for instance, the synthetic markets now, you can trade whenever 24 hours a day. Although some people actually use price and time, but I don't really believe in that, right? I don't really think it plays out like that. Right? When the currency markets, it has specific times, right? Specific times in which would be better to do for trade opportunities. For instance, if you try to trade during the Asia session, you usually find spread. Like it gets so large, sometimes you find a spread. That's why I don't like you see spread being like this, maybe as you used to be doing London session. You see the spread widening and widening, and if you're not careful, you can get hurt in this kind of market, right? So and that's why I prefer the currency market a lot, right? Although I trade synthetic, but this is why I trade currency more because of the time and price components, right? So that is just the beginning of let's the introductory notes to this section. I want to say something that when it comes to I want to say that when it comes to trading, there is no perfect strategy. All right. This is a new trading week. All right. Today is Sunday. I want you to have in your mind that making losses this week is nearly inevitable, right? So you just have said that I'm going to make losses. You are going to make losses, but what you should aim for is not how to not make losses. It's how to make sure that your equity curve actually goes up, right? That regardless of losses or setbacks, your equity curve looks like this relatively. And your equity curve, when I mean that your equity curve going upwards, I'm not trying to say that it's going to be this straight. What I really mean, this is what many traders actually expect. That maybe they start off at $100, when the account was at $100, 100. And this is a very silly imagination that so many traders have. Their accounts will be at 100, right? Start off at $100, and then they expect it to just be so linear, like so linear. It doesn't happen. And this is what makes some traders to lose more than they should have, right? So you're having this unrealistic, especially in the market. The account should grow from $100 straight up to maybe 500. So you're expecting that your balance should look like. And if you're not seeing this, then you feel that you're doing something wrong. Meanwhile, you aren't doing something wrong, right? So this is a very false expectation. It doesn't happen. That's if there was any strategy like this, then I don't think that we'll be using risk management. Think about it, right? If it was possible for your account to look like this, then there wouldn't be any risk management. No need to say you should manage your risk. Now, I'm not saying that this does not exist. It doesn't happen. You can never find any strategy that looks like this, right? That will make sure your accounts grow. So stop hopping from strategy to strategy. Stop hopping from mentorship to mentorship. Have the understanding that even with what I'm going to teach you, there's going to still be losses, right? Your work is to look for how to minimize your losses while having progress. While in reality, a profitable trader account costs usually look like this. Maybe it starts off at the same, at the same. I think I should clone this. It starts off at the same $100. Let's assume that this is also 500 as well. This is how your account should actually look like in reality, right? So this is actually false. It doesn't happen. Never happens. And if you try to make this happen, you're going to see more disappointment and unimaginable pain, right? So what your account curve should actually look like is something like sometimes you actually start off and it eventually drops down before eventually going up, right? Then you might see the account drop down, right? You now have sometimes you might be having consolidation. Your account to go from 2000 to 25 goes up to 230, just ranging between the zone. This happens, right? This happens, and then my account draws higher again, comes down a bit, and on the long run, you see your account growing relatively, right? You may see some drawdowns, and then finally, your account is still heading towards 500. This is what a real account curve looks like. It's not this. It's not an account that's void of losses. This is you're sitting at $100 or $1,000, and your account is finally, maybe after 6, 7 months, it finally gets to 5,000. But you are not going to be able to avoid this kind of movement. Your account going up, dropping down, having periods of consolidation where you're just having wins loss. Like for 2 weeks, 3 weeks, you have not had any measurable progress, right? It happens, and it doesn't mean that your strategy is not right or is failing. This is what the financial market actually looks like, right? So, despite whatever strategy that you're learning or you've been introduced to, you are not going to have this kind of equity call. It doesn't happen. This is why so many traders get so frustrated, because when they experience maybe 5 losing trades or 3 losing trades or 1 losing week, they automatically start to believe that something is wrong, or maybe the market is having some kind of grudge against them. Meanwhile, the market doesn't even know who you are, right? Doesn't even know where your stop loss is placed. It has no particular bias against you, right? You're just the one giving yourself these false expectations. And when there are false expectations, then there will always be painful awakening, right? If you're having a false expectation, you always be awakening to the truth, and it's usually painful, right? So eliminate this false expectation. The market, your account curve will look like it doesn't happen, right? You might experience drawdown and all that, but what you are after is that on the long term, your account should go up, right? If you're following the processes, like I always tell my students at a mentorship, that if you follow the process, your results will take care of yourself. Just follow your strategy, follow your risk management parameters. Your account will eventually go up, but it will not be immediate. It will not be so linear. It will have periods of adversities, periods of drawdowns, periods of struggle, periods of when the market cannot really interpret maybe perception issues. You may be having personal issues, relationship issues, and it's kind of affects your trading account, right? So this is what you should expect, and that is what you should expect in this video, right? You're not going to have all wins. You're not going to have back-to-back wins. You're not going to have back-to-back losses either. You are going to experience drawdowns. You're going to see losses. But if you follow your system profitably, right, like I've done some videos on risk management, then your account is going to go here on the long run. So it's okay to have a losing trade and all of that. So that is how the nature of the financial market is. This doesn't happen. This is what your account will actually look like. Sometimes this range can last for as much as 1 month, 2 months. Your account is just doing this, up, down, up, down, up, down, and it's normal. It happens to every trader, right? It happens. So sometimes it may go up, you may see this drop down. It happens, right? So that being said, we can go up to the topic of today. So eliminate the idea of trying to get a perfect strategy or a perfect kind of trading. It doesn't happen, right? The only thing that can happen is that you may improve your understanding of the market. That means your win rates will increase. But even with a 50% win rate, 60% win rate, you will still encounter drawdowns. Sometimes consecutive 3 back-to-back losses, and it happens to every trader, right? So that's it. Now let's start with the first topic. Before we go over to the high probability setup part trade, we're going to look at the importance of time and price. All right, so we have something that's called, this is where it is very important in the currency market, right, and indices, right? So we have a time and price theory, right? So when it comes to trading the currency market, we have what we call the time and price theory. That means that always, and these are the 2 indicators that we use as I use as a trader, right? I'm not using stochastic. I'm not using moving averages crosses. I'm not using a kind of RSI, stochastics, Bollinger bands, all those things. I'm not saying it's not beneficial, but these are the only 2 indicators I use. I'm using time and price, right? Using time to know when to look for certain specifics, and price to know what to do, right? So when it comes to currency market, there are certain times in which you should be looking at trading, right? And we are going to talk about the London Killzone. Although there are other ones, Asian and New York, but I'll be focusing on this one, which is actually the most important one that gives a lot of reward, right? So what you should expect to achieve during the London Killzone, you should expect a 25 to 50 pips. It could be more than this, but this is on average what you should expect to make when you use these things I'm doing. So you are potentially looking at 25 to 50 pips profit or movement when you're looking at the London ICT London Killzone, right? So now let us understand something. So when is the London Killzone? When is the London Killzone? I will use chart very soon. So London Killzone, by now most of us are in Nigeria, but I will use the New York time first. So we're looking at a window between the 2 a.m. to the 5 a.m., right? And this is a New York time. So I'll just kind of transpose it to Nigerian time, right? So transposing this is simply adding 5 hours, right? The New York is actually 5 hours behind Nigeria, right? So they're 5 hours behind us. So if it's 2 to 5 a.m. New York time, just add 5 hours. This is why you're looking at potential trade setups. Add 5 to this, you're having what 7 a.m. This is why sometimes you see me trading before the New York session. Now, New York session just start by 8 o'clock Nigerian time, right? So this is when you're looking at potential frameworks, right? So this is the Nigerian time now. Most of us are in Nigeria. This is the time you're looking at trading, and it's very, very beautiful because if you're in the United States, you have to be awake by this time to make this entry. Imagine being awake between 2 a.m. to 5 a.m. every blessed day. So when it comes to Nigeria, we are actually at an advantage because this 7 a.m. To 10 a.m. are actually moments in which we are actually awake. But when it comes to New York, they have to be awake. If you want to use this framework to their advantage, you have to be awake by 2 a.m. to 5 a.m. So if you're in Nigeria, Kenya, and Africa, you're actually at an advantage because maybe if you're in Kenya, maybe 1 hour behind, it should probably be 6 to 9 or whatever. But your own is at the peak daytime, not midnight when you should be sleeping or catching some rest, right? So this is the time for you're looking out for these items. Although sometimes it might extend, right? It might extend to 12 p.m., right? It might extend to 12. So sometimes it might extend to 7 a.m. It might extend to 12 p.m., right? It might extend, but this is basically the time. So this is which is where the concept of pre-London session comes into play because usually the London session starts by 8 a.m. I think rounds up around 4 p.m. or 5. I'm not really sure now, but this is where it comes into place. Now, the reason why you would find movement on your chart before the London session is because there's actually a bank that opens by 7 a.m. and that is Germany, right? So we're talking about the ICT London Killzone, ICT London Killzone, right? The ICT London Killzone. And it's usually this is a high probability trade model trade, and this should be the last one that I'll be posting on the free YouTube community, right? Although we have other ones, maybe private mentorship, but this is one all of us are posting on the public YouTube community. High probability trades model trade. That's the last one, and this is how to end this series, right? So ICT Killzone high probability trades model trade, right? So now we understand that there are certain times in which you should look at certain frameworks, and now we have understood that you should expect at least 25 to 50 pips, and this occurs every single trading day, right? Now, understanding this, we have to understand what pairs to be trading. Now, the pairs to be trading or to be looking for setups are the Euro and the GBP pairs. Those are the pairs you should look at for Euro and GBP. That is, it could be Euro USD, GBP USD, GBP JPY, all those pairs that have GBP and Euro attached to it. So you're looking for London pairs because these two pairs are domiciled in London. All right, so you're looking at their ideal. All right, their ideal. So you're looking at Euro and GBP pairs. Now, the reason why we would usually find price movements before the London session is because London is made up of about the London session is actually made up of what I usually consider as we have certain pairs that make up the London and British nations. So their currencies, it involves countries like Italy, Germany, France. These are the countries that actually are classified as London countries, the British countries, rather British countries. So actually look at Italy, Germany, France, and about 6 or 7 of them. I can't really remember all of them. So yeah, you have the UK, United Kingdom, etc. Right, and out of all this, we have the Germany bank opening by 7 a.m. So usually the Germany bank opens by 7 a.m. Nigerian time. That is why you usually find movement before 8 a.m. So the Germany bank usually opens by I think they're kind of 1 hour ahead or something of that sort. So usually open by 7 a.m. because now London and New York actually, London and Nigeria actually use the same time, but this particular pair this particular country opens their bank opens by 7 a.m. That is why you usually find movement on the charts before 8 a.m., which is London session. So you're basically looking at this bank. This is actually what is responsible for this movement because it's part of the British countries, Italy, Germany, France, UK, etc., etc. There are about 6 of them, right? I can't remember others, but these are the ones I can remember: Italy, Germany, France. These are the pairs that actually make use of euro and British pounds. These are the pairs that use euro and British pounds. These countries, right? About 6 of them. So Germany opens by 7 a.m. Unlike other banks, open by 8 Nigerian time, right? So that's why you find movement before 8 a.m. And that is what sponsors this, right? So these are the pairs you're looking at. So you're looking at pairs, especially I prefer Euro USD or GBP USD because those are majors, right? You could go for GBP JPY, all those pairs that have GBP Euro attached to them. These are the ideal pairs to be trading between this time, right? So now we have understood that it presents 25 to 50 pips at least every single trading day, right? Between 7 a.m. to 10 a.m. Nigerian time. Then you have a specific time to be looking at for trade setups, right? So you're not just like synthetic, you can check by 1 p.m., you can check whenever, but this is giving you a specific time. So you know when to be on your charts, right? This is why I prefer currency a lot because there is a time component. So I have a specific time, to be looking at charts. I have a specific time to be looking at the charts, right? So that being said, now we can look at what it should look like. Now, typically, if you're talking about the London Killzone, what should you really be expecting? You're expecting that price should go below the open of the. Okay, now for you to actually maximize this, you might want to go to your trading view and set your time zone to New York. So you can see this in players perfectly, right? So you can see their team player perfectly. Although if you're Nigerian time, you have to always be transposing this, right? But it's usually preferred you just use New York time so that it's easy for you. So you're looking at for what 2 a.m. to 5 a.m. Just basically the same time that you're looking at it, right? So now what should you expect in it? So in the London Killzone, on a bullish day, you want to see price, you want to see the midnight candle. So you want to see the midnight candle. Let's assume that the midnight candle opened at this level, right? Let's assume that this was the level price opened at, right? And this level was, let's say, 0. This was a midnight open. So midnight. All right, let me just write the price level there. So the 0.9850, right? Let's assume this is 0.950. We're assuming now, and this is the price level as the market opened during midnight. All right, and this was a bullish day. Maybe the bigger time frame was bullish, and you expect maybe you're seeing liquidity at the upside. And I'm not going to go into details now. So maybe price, this was the midnight open. Then you saw price open here during the midnight. Right, the London midnight open. So the New York midnight open, right? So the London midnight open, right? The New York midnight open, right? When 12 a.m. started. So let's assume that price opened at 9850, right? And maybe you saw liquidity at the top here. Maybe it was kind of equal highs here or something of that sort. And maybe you expect the market to poise higher, right? So what should you expect? Now, maybe you have liquidity at this point here. Maybe it's a kind of equal highs or something of that sort, or maybe an old high, an Asian high, right? A previous daily high, or something that should be cleared in response to what so maybe there was some liquidity resting at this point here, right? So some liquidity resting there at this very high, right? And maybe the market is bullish on the bigger time frame, right? So now what should you expect? When price opens there, you should expect price to do what? To first of all drop down. So into the market, usually during the London Killzone, the price usually do what? Drop down first before going high. So I want to see the market drop below what? The open price of the midnight candle. That means when the midnight open, that is the 12 a.m. New York time, not 12 a.m. New York time. It gets to be around 5 a.m. Nigerian time. So 5 a.m. Nigerian time is when you transpose, because you're always taking away 5 hours. That's a 5 hours difference. So if it's 12 a.m. for New York, then it's 5 a.m. for Nigeria. If it's 2 a.m. for New York, then it's 7 a.m. for Nigeria. If it's 5 a.m. for New York, then it's 10 a.m. Nigeria. So if you're in Nigeria, you're looking at the candle that opened by 5 a.m. So What you want to see, want to see the price was drop down first, go below was the midnight open. And when it goes below the midnight open, once the price, maybe it could go up a bit, once the price run down. And when it does this, what are you looking for? You're looking at for what? A bullish setup. You want to see price do something like this, right? Give maybe something like a reaccumulation, a kind of bullish setup. It just below what? Midnight open. It may not be exactly below. Sometimes it might be something like this. I'm just giving you a framework now. When you see price go below down, you can actually do something like this. Come down first before finally breaking up. Right. So now this has also given what? A bullish break. And now you're seeing what? Liquidity resting at this point, right? It might not be liquidity, it might be an old high. It may not that different kinds of liquidity, right? This is something that many people don't know as smart traders. As smart trader, it's not only equal highs that represent liquidity, although equal highs are the most obvious one for a newcomer. But there are other kinds of liquidity. We have previous daily highs, previous weekly highs, previous weekly lows, previous monthly highs. We also have imbalances, like imbalance are a form of liquidity, right? One price to tap into an imbalance, right? So I'm not going to talk much about that because that is not the concept or the topic for today. Now, when that happens, you see price drive below the midnight open price, which is the New York midnight open. You want to see a kind of bullish setup. It's come in form of a weak to stronger transfer. It's come in form of a bullish fair value gap, a kind of bullish model that gives you a framework to do what? Take price higher. This is what you want to see. Now, when market breaks above or give you this bullish setup, what you see enter a buy, and then you're looking at least 25 to 50 pips. It could go above it, but you're into the buy around here. This is sorry. Can you buy here? You're targeting what? That area of liquidity, and that is it. So it's going to be very fast. Between 8 to 10, you're done. 1 to 3 hits, and that is it. You've got it. You're trading for the day. You reach the 1 to 3, you enter the stop loss below the low, and then you've hit your target. That is all what New York Killzone is about. You want price draw to an area of interest after going below. If it's for a bullish day, the certain price was go down first. What price go below that open and give you a bullish setup in form of a total soup, a form of a weak to strong hands transfer, of a mitigation of another below, something of that sort. One price will drive down and then give you this and then it take price high. That is what you should expect. And now, if you look at that was not good. So the reverse for bearish days. For bearish days, it's just the reverse, right? So you're seeing for it's just the opposite. So you want this is your openers, now 850. Right? You want price to first of all go up. One price to go higher than the midnight open. You're looking for a bullish framework of a bullish, right? And once this is done, then I do what take price low. So you must have a higher time frame premise, right? You must have a reason to want to do this. Not that you're doing it counter trend. You must have this based on the bigger time frame. I'm not showing you setup. I'm not going to give you counter analysis here. Not say this is what frames when you have done your analysis. Something like that. So I said I want video as some effects. I've kind of if it should actually go lower first, but what's looking out for if the market is bearish, it could actually go lower first, or it could just go higher directly, right? It doesn't matter. It doesn't matter if it goes higher or goes lower first. But we want to see price. If it's a bearish day, we want to see it go here relatively. When it goes there, you have one price to drive above, give you that bearish setup, and then now you can take price what's lower. That is all what this ICT is about. So that being said, I don't want to spot up longer than this, so we'll just be heading over to real chat to see if you can spot these things out, right? So now we have seen that. Let's delete all of this and we can go on to real chat, right? So now let's look at this USD. Right. So let us start from maybe let's go back a bit. Right, let us go back a bit. Now, what day was this? We have been super bearish on this guy. So let's do quick little analysis. So let's show that we have been bearish on this guy. So just quick top analysis. So looking at the charts, you can see obviously market has been doing what bearish. So we had what bearish such a lower high, lower low, lower high, and then lower. So we're having a bearish market. Zero to discount. So we have what Fibonacci 2 that's hit what the 61.8 level, and and we also have a kind of what institutional candle here. So we have an institutional candle from the open here up to this point. So we have hit that IC candle. Why is it an IC candle? Because what it took out was stops. If you don't understand IC candles, please, you might want to go simply and watch my video I made on institutional candle. Right? I'm going to be kind of fast, but I don't want to be talking about too many things. So I cannot understand the framework for this particular module. All right. So you have your IC candle. Price has mitigated it, right? So that has given us what a bearish setup. So we can start looking for what sell ideas. So let us simply jump quickly to this particular candle that was bearish, right? Let's quickly jump here. Now let's go to the 1 hour, let's say 10 minutes time frame. All right. So remember what I'm looking at for. So now this was Monday. I don't know what day it was. I'm trying to get the framework now. So price hit that area we're looking at for. Right. Right. So look at it there. Look at what I'm teaching you. Now, what do? You simply go, we have a bearish setup. Remember that on the bigger time frame, we have what a bearish setup on this particular chart, right? So now knowing that, what are we looking at for? We simply, what time is the New York midnight here? Where is it? Here. Midnight. So now since this was New York midnight, somewhere around there. That is the open price of New York midnight. And what can we see here? Market was bearish. What do we see? Amazing price did what? Went above what? The midnight open. What did you see here? You grab liquidity. And what happened next? Can you see? It's open there. First of all, went lower, went higher, grab liquidity, and what happened? Bam. It went lower. Right, I'm trying to see something. All right. There was actually a break cost. So now let me go back to the candles. So looking at this, there was actually a break of structure because price actually closed below here. So we had a bearish break around there because market actually closed below it. So we had the kind of bearish break. Only it was a slight one. So we had that bearish break. We had what an IC candle inside there. That's last up move or whatever. So this was the last consecutive up candles. You can see 1, 2. So now understanding this, you have a bearish setup, right? So you have this IC that they took out for liquidity. So you're combining it with smart money concept, right? So you had that liquidity run, break below, and you can see that kind of liquidity building here. When the market opened, first of all went down, then it ran higher. If you were watching this, you would have just simply put your short position here, although it was not very clear. So you're looking at for what sell opportunities above what the midnight open. So if you put your sell here, sell above what the range high, right? Just a bit above that range high. Just here. That being what? I remember you're looking for what 25 to 50 pips on this. Right? So if this was your entry and your stop loss all the way here. See? And where we should be targeting? Area of liquidity. Now, let us look out for area of liquidity on this particular chart. Right? I'm giving you the context behind this. Now, look at this chart. Can I see liquidity here? Can I see? So, I'm looking at this as this lows as a kind of liquidity. And where was it? It was close to my 1:3. So you can use lows, this kind of low. So I have that open. Let's get 1:3 from there. So 1:3 was somewhere around there. And that was a very good area for TP. So if you're using this particular low, because some people look at this as what a kind of support or kind of demand zone. Those are obviously liquidity. So if you did this entry, stop loss above there. Guys, bam, 1:3. Now let us look for another setup. Let's look for another midnight. So that was a beautiful sell-off. So we are still bearish on this guy. Let's look for another day, this pin pendant. All right, so we're looking for another midnight. Let's see price will run through and all of that. Right. Let's look for another framework behind it, right? All right. So this is a midnight. Okay. Let me get the midnight open price. So midnight was somewhere around there. Where's that midnight? Yeah, here. So market opened here by midnight. What do we see? Market ran higher, right? Let us see there was a need setup on that. So we had market run higher. Um, right. So let's see there was any particular setup on this particular day. Mm, let's look closely. So looking at this, I can see that okay, price went above the midnight open, but I can't really okay, I can see something here. I can see something here. So market first of all, it went this was the midnight open. Although I wouldn't have taken this because I was seeing some kind of, I would have expected market to do was take out these equal highs here because that's what I would have expected. So the market was likely going to run higher before selling off. So I wouldn't have taken this, right? I wouldn't have taken this. Now look closely. This was actually the minute open. Pay close attention. Now you see market to run there. Then let me make this a little bit light so that uh, I can actually see what I'm looking for. So now there was actually a kind of liquidity run here. Although this was liquidity was kept intact, but look at it was actually kind of run at this point here. Right, we saw this run and now we saw a break of to the downside, right? So even if that would have not been a better entry, so this actually ran above here. There was kind of a rejection here. So this large down candle. Some people saw this candle now. I look at it now. Now some people would have been like, okay, this is a kind of resistance zone, right? So they will draw a kind of line here. They'll be okay, the resistance zone, whatever. So they will likely be selling here. And after they saw what this down candle, they possibly glue themselves. And the classic candlestick Bible will tell you that once you see a sell, just simply put your stop loss above the bearish engulfing candle or something of that sort. All this funny retail logic. And these are the things you should not be doing. So they'll be like, okay, this is the last area of support. This was a rejection candle. Sell. Once you see the big candle, you sell, and you see that did not happen. So there was a kind of liquidity run at this point here, right? After they saw this candle, market actually ran above this support and resistance, and you see ran above and then finally broke down. So we now have was a bullish setup. Although I wouldn't have taken this because of this equal highs, I would price go higher, but that did not happen. So we now had that break to the downside. And what the price? The price actually came back for this last consecutive candle. I have said severally in my previous classes that the order block is not necessarily one candle, right? So it already came back to mitigate that bullish run that actually went above midnight open and took out stops, right? So that would have been the trade that although I would have seen this as a liquidity, I wouldn't have taken it, right? But that was actually a price, but this was also perfect, right? So if you took your trade here at the open of this, when price broke and came back there, if you got at the open of this consecutive candle, which is the order block, right? Stop loss above that. Let's see if you give one to trade. Let us see if you give. So first, I was targeting this low because I can see this low as an area of liquidity. So I'm like targeting this low for take profits, and you can see the price get there. It did. This would have been 1 is to 2.3, right? So if you're risking, some people always say that 1 is to 3 is the best, but for me, if I see opportunities that give 1 is to 2 or 1 is to 2.1, any business that you can get double of your investment is a good one. If you're in a business and it can give you double of what you're investing, that's a good investment, right? So if I was taking this, I would have targeted this low as my take profit, and you see, price could have traded towards this, bam. So we had this break. This was what sponsored this. The reason why price did not come for this was because there was this break, right? So if price went above this after coming here, would have been a kind of counter structure, right? Maybe just a week, but you see that this was actually giving us a new range. So based on this chart, we had a range between here and there. So price did what came back to that range and then what gives a sell off at that order block. Order block is not one candle. Order block is not the last candle. Order block is not the very last candle. It's the last move. As long as you can see the move starting from here and ending here, that is your order block. Because an order block can be one candle on the 1 hour time frame and then 3 candles on the 15-minute time frame, or 50 or 4 candles, right? So when you order block as the last candle, you're missing out, right? So price kept the security intact, maybe for a future date, because market was bearish. You can see beautiful run, bam, right? So let's look for another particular. This will be the last one. I don't want to be so long, right? Let's look for the last particular day. Guys, I'm just showing you the framework. You have to understand the bigger time frame perspective with this, and we identified it was what bearish, right? Let's look for the next kill zone, which is between 2 o'clock to 5 p.m. Look at, I forgot to even point that. No, I forgot to say this. Now, look at this. What time did this happen? Was it between our time? Look at it. This whole thing happened between what? Look at it. Look at it. Look at the time here. This time was what? Can you see it? 2 o'clock. Can you see it? 2 o'clock New York time. And when did it? And it was happened between this is 2 o'clock and this is what? Sorry. I need a horizontal line. I want to show you this the concept. I forgot to if you mark this out. So this was 10 o'clock. This 10 o'clock was somewhere around there. Can you see that all this happened between what? The time I gave you beforehand. Between 2 o'clock and what? 2 o'clock and 5 a.m. Sorry, not 10. So this happened between 2 o'clock and what? 5. So it can actually extend, right? Especially if you're in a trade before then. So you can see that this setup appeared what? Between what? 2 a.m. to 5 a.m., which is the New York time. You can see all this happened between that time. And this was the kill zone. So if you enter this area around there, then you can like to run to your what's the target. So you can see that this was actually the ICT London Killzone between 2 a.m. and you can see the opportunity was present between 2 a.m. to what? 5 to what? 5 a.m., which is our 7 a.m. to what 10 a.m. Let's just look at this time. I forgot to mention that. Now the same thing here. Let's mark our 2 a.m. Like I said, 2 a.m. is where somewhere around here. You can see 2 a.m. Can see 2 a.m. to what? 5 a.m. So it was a key zone. You can see this opportunity was present between what? 2 a.m. and what? 5 a.m., which is our 7 a.m. to what? 10 a.m. Nigerian time. Can you see that there is a particular time you're looking for what? A setup. This is not the time. The time is not when the day should begin and end. It is when there would likely be a setup presenting itself. Price tipping you and all right, I want to go higher, I want to go lower. This is how to actually trade with it. Have you seen how beautiful this thing is? You have a specific time you're looking at what a specific setup. All right. I think I was discussing with the prop firm trading students yesterday, and I was giving them a breakdown of how these things are beautiful. Right. I won't divorce so much on what I taught them because obviously I'm in a special class for that. But I'm just giving you the general framework to this. Right. You can see how this is panning out. And believe me, I did not look at this chart before now. Although I was trading this, but I didn't look at this chart before you say that, okay, he has already, did you see marking this up before now? I didn't. I even forget about the time. You can see how the things I'm tipping you actually pans out, right? So we had that IC candle, which was indicated on the bigger time frame. You may not know IC candle if you have not joined our mentorship community because you may not really understand this, right? Unless maybe you have to go to my channel and watch the video on institutional candles. But I'm just giving you the framework that between 2 a.m. to 5 a.m. New York time, which is between 7 a.m. to 10 a.m., there is usually a trade opportunity on the London and GBP pairs. I'm not using euro for this whole thing because I don't want to change charts, right? Now, let's look at for the last example and see if this happened, right? Believe me, this is not a perfect setup. There are days that you would have losses. Yeah, it will happen that you have losses. Yeah, there are days you will have losses while you're using this framework, right? There are days you will have losses. But doesn't mean that the goal of trading is to look out for opportunities that give you higher reward. That means even if you take 2-3 trades a day, do you know that if you take 3 trades a day, let's assume that you take 3 trades a day, right? You take 3. Now let us understand it. Why you should focus on these things I'm giving you. So if you're going to have losses, if you've accepted that, that is fine. Then how do you use the losses to your advantage? How can you walk through it? Is it by trying to find a perfect strategy that does not have losses? Nope. It is by using this I want to show you now. So if you have 3 trades in a day, if you took 3 trades in a day, 3 trades, right? And out of those 3 trades, you lost what? 2. Right? Let us see. You lost 2. You lost 2 trades. Right? And maybe let's assume that you are risking 1% per trade. So you are risking 1% per trade. Risking 1%. So risking 1% of your account per trade. So now you lost 2 and won 1, right? So you lost 2 and then you won 1. And remember that if you want this thing to work for you, you must have what we call risk reward targets. So maybe you're using an RRR of 1:3. Let's just use the basic one which I use. So you can go for 1:4 if you wish. So you always actually use 1:3. Now, if you lost these 2 trades, what do you have? You have lost what 2%. So you lost so you're 2% down. You're 2% down. Right, 2% down. Then if you now win 1, what are you? You're up for 3%. So 3% up. Now, if you do the maths, you will see that even though you lost 2. You lost 2 trades. But since you're using 1:3% RR, what are you up? You have what? A net gain of what? 1%. You can see? As even though you did what? You lost these 2 and won just 1 out of the 3 days you took. You can see that you're still what? Relatively profitable. This is why I'm telling you that I said earlier, if you need to come watch that particular part, that you are not going to see a linear curve on your account. That is unrealistic. Your account usually look like loss, loss, win, win, loss, loss. It's going to happen. But what keeps your account on the long term upwards is what these systems using good risk reward ratio and knowing the best time frame setup, using the higher time frame premise. Now look at what I'm showing. All these things I've been showing you, I never pointed for a bullish setup. I was looking for only bearish. Why? Because the bigger time frame was bearish. That is how to manage your trade framework. So you're looking at opportunities that are in line with the bigger time frame. You're looking at what specific time, and you're using what we call the risk reward ratio. These are the things that I wasn't taught as when I started trading newly. Right? The people in the mentorship academy are advantaged because they are having this information beforehand, before they go and blow thousands of dollars like I did. And I'm giving you this for free early, that you don't go and start looking for a setup that is 100% wins. It doesn't happen. And let's assume that you have, let's assume that, okay, luck smiled on you, and then you took 3 trades, all wins. You took 3 trades, all right, and all wins. And then because you don't manage your risk, so you took all these 3 trades, and they were all wins. You don't use the risk reward, and then maybe you are up 10% on your trade. You won all of them, and then the next trade, because in your mind you are now the god of the markets, you are the king of charts. You don't make losses. Then in the next trade, you took your next trade. You didn't use a stop loss. You don't have any stop loss because you are a consistent winner. Why should I use a stop loss? Because I win on my trades. Now, your 4th trade, what happens? You start seeing drawdown. You refuse to accept that may be a losing trade, right? Start your 1st trade, you start seeing drawdown. When you should have used a stop loss, maybe 1% stop loss, and then you allow the trade, hoping that it will reverse. It's just one of those things. After all, this is a perfect strategy. It's just maybe one of those down days you're having drawdown trade from there. It goes to 5% drawdown. You're still holding it. It's going to reverse. It's a 100% setup. It goes to 7. It goes to 10. You're still holding the trade because you believe that it's a perfect strategy you use. And finally, when you finally close, maybe it gets to 30%. Now you can see that even though you won 3 trades, your 4th trade has almost cancelled all your losses. Can you see all your wins? Sorry, the 4th loss has cancelled all your wins. You can see that it's not about winning all your trades and make you profitable. It's about managing your portfolio using the things I'm keeping you, right? Can you see how this is pan out? So now understanding this, you're not looking forward for an unrealistic stuff, right? Can you see how this is pan out? Now let's look at the next day and see if there was another ICT Killzone entry. And this is a beautiful class, and sadly some people don't think it is worth their time. That is fine. One day or the other they will still come for this lecture and okay, yeah. So now let's see what happened there. Now, our usual thing, let me remove this. Our usual thing is we're still on a bearish day, right? We're still bearish. This guy, here's our midnight open. Our midnight open was somewhere around, yeah. So price, it was, first of all, it dropped down. You can see a kind of bullish break. So market dropped down and broke this short-term high. So we have a bullish break on this. So let us see. I'll look at this as another block. Right? And not only that, consider what the price did. Price did was, no, I shouldn't be looking for bullish setup. Sorry. So price, first of all, it ran down, but we're seeing the price to go up first. So this is not really consequential to us, right? So we're looking at for bearish opportunities. So this is not what we're looking at for, though. Or we would have liked price to go higher first before going down. Let us see what happens next. So price ran higher. Yeah, that is it. So now I can see the setup now. So look at what happened. First of all, price ran down. That is not what we're looking at for because we are bearish and we're looking for price to go above the open price and give us. Now we have our time window, which is between 2 a.m. So where's our 2 a.m. here? Somewhere around, yeah. Okay, this 2 a.m. Somewhere around here. Although it can extend to 7 a.m. right? I told you it can extend to 7 a.m. So let us see what happened there. So price finally went up. Then we had a run on the stops here. We had this run, and then I think that's what happened after that. Okay, so finally we had a bearish break on this, right? So market finally broke below this, giving us what a bearish setup, which is our IC candle, whatever you call it. So we had that IC candle, that bearish break. So now let us see. So I had a bearish break. Right, I told you it can extend between 5 a.m. It can reach 7 a.m. When I saw that the key zone can reach 7 a.m., which is 12 p.m. Nigerian time, right? Just always, whenever I say 12 a.m., add 5 hours to it. That must be in the New York time, right? So this happened between 4 to 5. So setup came up, it was between 2 to 5. So there was a setup present between them. So now I'll look at this as what the last candles of my SC. So I'll look at this for myself. So that maybe if I was watching it, I would have maybe sold, targeting this low first TP. But let us just see if he hit 1 or if he took us out, right? I can't remember what happened there. Let us see if it was actually a winner or a loser, right? Let us see. Because they're going to be days that it will be a loser, right? This is not his 100% guarantee. It's just a higher probability that it has an higher odds of penning out, right? So, folks, look at it. Broke down. Yeah. If I saw this bear, I would have simply gone short here. Stop loss was above that high, right? Above that range high. Let us see. Let me just extend to 1-3 and see if it got there. Let us extend and see if it got to 1-3. Right? I doubt it did, but let us see if it did. Because once there's somewhere around there, let me see if I can find liquidity around there. Let me look at the left. Let me look at the left and see if there's something of interest around there. Okay. Unless there was not interest around there. I'm trying to see if I can find out of interest around there. Right. All right. So okay, I can see something now. I can see. What can I see there? Okay, I can see this liquidity resting here. So I can see equal some kind of liquidity resting there. Okay, liquidity was there, so I had the reasons to go down. Right. So that would have been enough for me. So let us see if there was it's actually panned out. Right. So let's play and see if it's actually got there. Let's see if it was losing there. Did it? So you can see how I've given you a framework behind this. This is a high probability setup that you're looking at specifics. You can see one can do 1-3. That is it. That is all you need for a day. If you can make up to 1-3 3 times a week, do you know how much your account will be? If you're risking 1%, you get 1-3 for 3 days in a row. Like 1-3 first day, second day, third day, you're up what 9%. If you're using 0.5%, you're up 4.5%. If you're using a big account, like I encourage my students to do with a professional account, that is a lot of money, folks. You can see how there's a particular framework to this. This is actually the drag stack. This is a high probability trade. It's something that doesn't occur often, and many people don't teach. All right, I'm giving you the concept behind it, and this is what you're looking at for specific times, specific biases, and specific targets. Right. So this is the end of this discourse. Right. So I'm ending this call here. So that is it. It's not something that, and the best part of this class is that you have to go to. This is what will separate those of you that will make profit of this and those of you that will not make any progress. And this will just be a waste of time. Is just that there will be a difference. Those that will actually go back to their chart and back test these things are the ones that will actually see progress. Why there are ones that will not back test, just want to trade it and begin to ask big questions. Those are the ones that will not see any progress. But if you're one of those that will go back to your chart and look out for these specifics, then you're the one that will see results. All right, so I hope this was insightful. This is something you should backtest. It is actually a high probability trade setup. If you are blessed on this class, drop something in the comment section because I'll be uploading this on YouTube in a moment from now. So this is the I'm not taking any questions now because if you have a question, just drop it in the comment section on YouTube and that will be all. So until next time, have a wonderful day. If you want to join our mentorship program, it's still ongoing. All right, so this is just a tip of the iceberg. It's right. Those ones that are in the prop firm trading community, we teach a lot. Like we go deep down into things that are not being taught on the public channel, right? That is why you should enroll for mentorship because we cannot give you everything for free, right? These are the things that we keep up for our students that are determined to learn, right? So that is it. Have a wonderful weekend. Have a wonderful day. Know that you're going to make losses. Accept it. You don't accept. Everyone accepted before. We're going to make losses this week. That is guaranteed. But are you going to be profitable? It is up to you, right? So cheers. Have a wonderful day. God bless you all.